Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that smells a bit like a last-ditch effort to keep the lights on, a financial maneuver that might just be a recipe for either a brilliant turnaround or, well, something less desirable. But before we unpack that, if you like breaking down complex reports into hopefully easy to understand explanations, make sure you're subscribed. We also have a Discord community linked down below. Join up to chat about this and other SEC filings. We're looking at a report from zSpace, and it all focuses on an agreement they've entered into, a common stock purchase agreement. This is like saying they've made a deal that allows them to sell stock of their company to another company called Stone Capital. Think of it as opening a tap to get some cash when they need it. Basically, zSpace has the option, not an obligation, to sell up to $30 million worth of their stock to Tumim. They don't have to sell all of it or even any of it. If they don't want to, it's entirely up to them, a bit like a financial safety net. This agreement gives them a way to get some money. Now, there are some rules. zSpace can ask Tumim to buy shares, but there needs to be some time between requests. This prevents a flood of stock hitting the market at once and possibly tanking the price. The price of the stock also needs to be above 1 cent. zSpace gets to decide when and how much stock to sell based on things like market conditions, the price of their stock, and how much people are trading it. Basically, they're trying to get the best deal they can. To make this deal happen, zSpace has also agreed to cover Tumim's legal costs, up to $25,000. Call it a thank you for their trouble and a promise that they will be reimbursed. There's a limit to how many shares zSpace can sell to Tumim without getting approval from their other shareholders. They can't sell so many shares that Tumim ends up owning more than 4.99% of the company. This is to protect the existing shareholders from having their ownership diluted too much, making their shares less valuable. If zSpace does sell shares to Tumim, they plan to use the money they get for a few things. They will spend on day-to-day expenses, things like salaries and rent used to fund future projects and other general business needs. Space also has to file some paperwork with the government, specifically the SEC, so that Tumim can resell the shares they buy. This is a common legal requirement when companies issue new stock. The whole agreement between zSpace and Tumim has a timeline. It will automatically end if certain things happen, like if 2 years pass, Tumim buys all the stock, or zSpace's stock gets kicked off the Nasdaq stock exchange. zSpace can pull out of the deal anytime they want after it starts, but they have to give Tumim 5 days notice. If you want the nitty-gritty details, copies of the actual agreements are attached as exhibits to this report. So if you are some kind of legal expert or just incredibly curious, you can dig into all the fine print. There is a section mentioning that the potential sale of shares to Tumim hasn't been officially registered with the SEC. That just means it is not final and they need to follow rules before everything is legal. But of course there are exhibits attached, agreements and related documents which are a standard part of these kinds of filings. Ed Deegi. Now, what does all of this mean? Here's my take. This stock purchase agreement looks like zSpace might be needing some extra cash. It's not necessarily a bad thing, but it does suggest they might not be swimming in profits right now. The fact that they have the option to sell shares but not the obligation gives them some flexibility. But it also means they're relying on the market being favourable to sell those shares at a decent price. The risk here is that if zSpace sells too many shares, it could dilute the value of existing shares. It is a delicate balancing act. They need the money, but they don't want to hurt their current investors. On the flip side, this agreement could be a good thing for zSpace. It gives them access to cash when they need it, which could help them grow the company, invest in new projects, or just keep the lights on during tough times. Overall, this filing tells us that zSpace is taking steps to secure its financial future. Whether it's a brilliant move or a sign of trouble remains to be seen. Investors should definitely keep an eye on how zSpace uses this agreement and how it impacts their stock price. So what do you think about this deal? Is it a clever strategy or a cause for concern? Let me know your thoughts down in the comments. If you found this breakdown helpful, hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community in the description below. Thanks for watching and I'll see you in the next video.